Um, just to start, I want to just thank you all and those who are online. We have people joining from different places. Um, this is a presentation on the new law that passed on July. It was signed by the President on July 4th of this year. To start, just a few logistics. We have people who are joining here in person at 36 Patrick Drive at Bethel Christian Center. We do also have people who are joining online, those who are viewing through YouTube. And also we have a Zoom link that has been shared as well for some folks to ask questions live, as well as you can use Zoom to send text message in terms of asking questions, as well as you go to the YouTube channel and through the message link and share your question. For the people who are here in the room, they can just go forward and ask questions and they will take on. So the presentation will be in English, but we'll also try to mix it in with Kinyarwanda and other languages depending on who is asking questions or need more explanation. So there are mostly our presentation will be focused on taxes. There will be a few things that I would like to share with people who are here in person as a bonus at the end. If you stay until the end, there will be a couple things that are outside taxes that I'd like to share with you. And for the folks online, we'll focus only on tax changes. So the bill or the law that passed by itself is around 900 and plus pages. As you can see, we can't be talking about all the pages. There are so many things in this tax bill. And just to give you a little bit of background, every time we have a new president, there is a new tax bill that gets introduced through the Congress based on the priorities of that president who was elected. And then if those the changes that are being suggested or new priorities from the president get passed through the Congress and then signed by the president, become law. That's why we see in every time when we have a new president, there's a new kind of budget or tax bill that's passed. There are also other bills that continue to pass during that terms that probably didn't get into this bill. And in this case, there are still other things that Congress is still undergoing discussion. So this one is kind of a unique one. I don't know if you recall those who were here during the first term of President Trump. There was a so-called Tax Cut Job Act that was passed in 2017. At that time also we had a conversation with a group here talking through the changes that were in that tax bill. This year, this tax bill that passed has a lot of things, not only taxes, but had a lot of changes to what existed as a law now. As you know, everything that is here, some of the provisions here have been made permanent, meaning that they will not change forever unless a new president come in and change, and the Congress decided to make those changes in the past. And that's what the expectation is. So there's nothing, even if it's permanent, it remains permanent forever. It depends on the next administration and what they would like to do about those specific provisions. So without further delay, let's go on and start. As I said, questions can be, you can interrupt me anytime, or you can just text your question, and then after, when we pause, I'll take the questions and then we address them. So we have two parts. I put them in two parts. One is provisions that impact individuals, and there is also provisions that impact the businesses. We'll start on individual level. So going back again to the tax structure itself on individual, I know most of you have been here for quite a long time, and you know that here in US, during the month of January, usually end of January through April 15, is what we call tax season. So when you do work during the year, you don't pay tax. You can elect to have tax withheld. It's like you're advancing the government, or you can elect not to do anything, not to pay anything. But when it comes to the period of so-called tax return or tax filing season, that's when you actually going to pay tax based on the income that you generated during the prior year. So that's the way the system here works, which is quite different from what we are familiar with from Africa, where you pay tax when you are making money. So whatever you get deducted on your tax return during the year here in America can be refunded back to you if you don't owe any tax. So the tax filing is where you do the calculation based on your income using the tax law, and they will see if you owe taxes, then you pay comparison to what you already advanced. If you've paid more, they refund you. If you paid less, you pay the difference. So in this provision, which going back to the TCJ, which is the Tax Cut Job Act from 2027, but it was effective 2018. But was effective 2018. The provision was to reduce the tax bracket. The tax brackets, meaning that the way we get taxes, normally our income get divided in different brackets. So the brackets used to be 10% up to 39%. And when the TCJ was passed in 2017, they reduced to the maximum of 37%. So no one up to now could pay federal income taxes that is more than 37%. But this was supposed to expire this year. Starting 2026, we were going to revert back to the original tax brackets, which went up to 39%. So this new provision in this tax law that's passed made these brackets permanent. So now, unless the Congress change the law, no one will pay tax that is more than 37%, will be more than 37% bracket. And then they made some adjustments to adjust for inflation. So each year, because you know, when we talk about inflation, it's mean about the value of money. The dollar's value changes every year, and all the time the value goes down. So $1 today is less than $1 tomorrow, and that's what they call inflation. And when they see what amount need to go to each bracket, they adjust it based on the inflation. Go next, Joel. So now, the other provision that is in this bill is the standard deduction. So again, I'll keep comparing with what existed and now. When you have an income and you're going to file your tax return, before they determine the amount of tax that you pay, they give you what they call deduction. That's a government-provided deduction. So people have two options. You can elect to use the standard deduction, which is a deduction given by the law for you to deduct before they can tax you. As an example, let's say you make an income of $50,000, right? You have a total year income of $50,000 and you are single. The government say that instead of taxing you on $50,000, we'll deduct $15,000. Then we tax you on $35,000. That's what they call deduction or standard deduction. If you are head of household is someone who's not married but has dependent. So some families you find that they have only one single parent with dependents. That's how head of household. So if you are head of household and you've made a total income of 50,000, you deduct 22,500 before they can tax on that amount. I think this is clear, right? So now those are deductions: 15,000, 22,500, or married filing jointly 30,000. Those amounts are being adjusted upwards in these new provisions. So in this new tax law, they increase 750,000 for each individual. So if it's a single, instead of 15,000 deduction, is now $15,750. For head of household, instead of 22,500, is now 23,625. Married filing jointly, it went up to 31,500. So that's one of the changes, which is a positive change for individuals who are filing tax return. They're going to see this year, which is the filing will happen next year, a little bit of tax benefits as result of this change. Okay? So now, next is now another addition. I don't know if you remember during the Trump campaign, one of the things that he was saying that he is going to eliminate tax on Social Security. So, so just to explain to you about that, folks who are 65 and above, considered retired individuals, if they make money from job with those who continue working, and on top of that they receive Social Security benefits, the tax law does tax Social Security benefits if they make more money than the threshold that's been set up. So that's why when during Trump's campaign he was advocating on removing taxing Social Security regardless of how much the individuals who are 65 and older can make outside the Social Security benefits. So when in this provision which was signed, that did not go through. Social Security is still subject to be taxable. But instead what they did, in addition to the standard deduction that I explained earlier, they add for anyone who is 65 or older can add another $6,000 of deduction. So if, let's say, you're 65 or 67 years old and you're single, your deduction will be $15,750 plus $2,000 that used to be added as a senior deduction. Now they're adding another $6,000. So you can see that your deduction, and again, the deduction is the amount that they remove will not be taxable before you get taxed. So they get that $6,000 addition instead of removing it completely. So that's another change that affects individuals that are 65 or older. But remember, all these deductions, they have a cap. If you make more money, you won't be eligible for this deduction. So like just for senior, if it's a single, they start phasing out if you earn more than 75,000. If you are married, it's 150,000. So that's it for the senior. Then we talked about another thing that's in this provision. Go to the next slide. Is the change to the itemized deductions. Again, you recall until this law, when TCAJ passed in 2017, they limited the state taxes. So we, for example, we are in the state of Maine. we know that we pay taxes to the state as well as to the federal. So before the TCAJ, we used to be allowed to deduct the tax that we pay to the state as an expense to our federal income if we itemize the deduction. And again, let me explain between the standard deduction and itemization. So as I explained earlier, you get the standard deduction, which is what the law gives you before you get taxed. You can elect that one, or you can elect to use your own expenses that are allowed by the law. That's what they call itemization. So when you do the standard deduction, that's all you go with. You can deduct also other personal expenses that are allowed by the law. Unless you elect not to take the standard deduction and just go with the itemized deduction. So this is what we're talking about, itemized deduction. So one is the state taxes. And when we're talking about SALT, which is state and local taxes, includes income tax that the state tax you, includes property taxes for those who own properties, includes also mortgage interest and so on. So for SALT is only taxes that you pay to the state. They use, for TCAJ, the previous law, limited to 10,000. You couldn't deduct under itemized deductions for the federal purposes more than $10,000 as a tax deduction to be able to reduce your taxable income for federal purposes. So this has been increased from 10,000 to 40,000. So now you can deduct up to 40,000 of income or property taxes paid to the state as an expense to under federal income. So that's again another benefit, because some people have been limited to that. Most of us, like when we pay to the state income taxes plus the property taxes that we paid was more than 10,000. We couldn't deduct that unless you have a business and then you use it as a business expense. And as you can see the chart, go to the next chart, Joel. So you can see to the chart that there is also a cap. So this is for someone who has a total income up to $500,000. When you pass $500,000 in your total income, that 40,000 becomes going down, and it dropped down to a low amount, to 10,000 again. So it's just for the folks who make up to $500,000. More than that, it goes back to cap of 10,000. But the good thing that most of people who make more than $500,000, they have businesses, and they usually use the tax paid to the state as a deduction through the business, because business is allowed to deduct without any cap. Next slide. Now, one other thing that was added to this new tax bill is the mortgage insurance premium. As you know, this was eliminated in the previous tax bill. That if, most of the time the mortgage insurance premium is what you pay as insurance that the lender asks you to pay if you did not provide at least 20% of down payment when you are buying a house. If you're buying a home and you pay less than 20%, most of the time the lender will require you to get an insurance, and you'll be the one paying for that premium for the lender. Some of them, they take it out when you reach the 20%. Some products for the loan, it's permanent, like FHA is permanent. So now, people used to pay those mortgage insurance, but can't benefit from tax deduction as an expense. Now, it came back. You are now allowed to also to deduct, in addition to the interest, you can also deduct the PMI or mortgage insurance premium. And that's now as long as your loan is up to $750,000. So once you have more than $750,000, there is some limitations of getting that deduction as a premium expense. We go next. The next one is the charitable contribution, or what we call donations to the non-profit organizations. So there are a few changes here, but before we go to the changes, I just want to explain to people, some people give donations, and most of the time they say, well, if I give a donation, I'll deduct all of it as an expense. Just understand that there is some limitations. Usually you deduct 100% because you did not limit that limitation. There's a threshold. So you can donate and deduct your donation fully up to the 60% of your AGI, or modified adjusted gross income. Usually the modified adjusted gross income is the income that you made in the prior year after excluding some of the deduction, like we used to have exemption, now we don't have any personal exemption. So it's up to 60% of that income. You can deduct 100%. Once you reach 60%, you start phasing out the donation that you provided. So let's say, for example, you make $50,000, and your 60% of $50,000 is $30,000, right? If you donate $35,000, you'll be limited to $30,000 donation. Does that make sense? Yeah. If you donate less than that, then you deduct 100% of it. So that's what it is, and it used to be, is 60% if you're donating cash. If you're donating a stock, is 50%. If you're donating any capital gain property, then it's up to 30%. That's for public charity. And there are two charities here. There is a public charity, which is like non-profit, known, that does activities, 501c3, that does activities to the public to help the communities. That's what you see under public charity. The non-public charity are foundations. So the foundations, they have different limitations. So if you donate to a foundation, instead of 60, you'll be at 30% limits of your AGI. Just to clarify that. Now, in this new law, they added, for you to be able to deduct as donation, you have to give out as a donation at least more than 0.5% of your AGI. Before, you could donate $100 and take that deduction. But now, if that $100 is less than 0.5% of your income, you can't deduct it. So, yes. Yeah. So that's one change in this. And the second change is, you remember during the COVID, they passed a law that want to boost donations, and it allow people who are taking standard deduction to deduct up to $300 per person for donations that they made. And that happened only 1-2 years and then expired. Now, they are bringing it up for the high amount and making it even permanent. In the new tax bill, even if you didn't itemize your deduction, you're taking a standard deduction. If you donate, you're allowed to donate and take deduction as an individual up to $1,000 as a deduction for your donation that you've given, even if you did not itemize your deduction. This does not exist. And if you're married, you can deduct up to $2,000 as a charitable contribution, even if you did not itemize your deduction. So these are two things that didn't exist before. They're being brought into the new bill. So this is kind of benefiting non-profit to get donations, even for small donors, and those small donors will be able to take advantage of it and get some tax benefits. Okay? Keep going, 2 slides. Next one. Okay. Qualified tips deduction. So this is another thing. Didn't exist, that is new to this, which is a positive. People work in the hospitality industry. Those people receive tips, like Uber drivers, restaurants, hotel, and other businesses that pay tips. So this was also in a campaign for Trump, who wanted to eliminate completely the tips. So you're going to hear more people, rumors, or people saying that now tips are not taxable anymore, which is not true. And I'll explain to you what's actually changed. If you are being paid tips, you can deduct those tips excluding from taxable income up to $25,000 that you've been paid as a tips. So for people working in those industries, they will see a change in their W-2. Now the W-2 will be showing how much tips has been paid versus regular pay. And those tips, if they are less than $25,000, they will not be taxable. If there are more than 25, only the amount that is above 25,000 will be taxable. The remaining will be exempted from the tax, which is a good news for the people who work in those industries. And these tips are limited only to those who are working in the industry of identifiers or hospitality regularly paid tips. But there is also a cap depending on the income. So the threshold for a single, the total income, to be able to deduct 25,000 of tips as non-taxable is $150,000. For married filing jointly is double, which is $300,000. As long as you are in that threshold, you can deduct, if you've been paid tips, up to $25,000. So that's another positive. And just to mention this one, it's only between now and the end of Trump's term, 2028. After 2028, it will expire, and things will go back as they were. So that's why I keep mentioning things that are temporary and things that are permanent. Things that are permanent, we're expecting them to continue. Things that are temporary, they have a time limit. Most of them, they put them through 2028, which is the end of Trump's term. Next. Yeah, I explained this. Let's go next, Joel. Okay, yes. So now another deduction that's new in this tax bill is the overtime compensation. So similar to tips, the overtime also was new in this bill, did not exist before. If you are being paid hourly and you earn overtime, you'll see on a W-2 your overtime being reported separately going forward. That's what we're expecting. And then your overtime pay will be excluded from taxable income up to $12,500 for a single and $25,000 for married. Remember, for the tips, there was not limit difference between single and married. But for overtime, it's up to $12,500 for single. You can exclude as not taxable overtime, and up to $25,000 for married filing jointly. You can exclude as non-taxable amount for overtime. I want to be clear in terms of way of calculating overtime, because that can be confusing for most people. So let's say, like in state of Maine, if you are paid overtime, they pay you 1.5, right? Regular is $1. Let's say you work for $1 an hour. Let's use the realistic rate. Let's use $10. You're paid hourly $10 an hour. If you work overtime, they pay you $15, right? So your overtime is not $15. Your overtime is $5. It's the amount that you paid over the regular hour. So that's the amount they're talking about overtime. Because I know some people work on hourly. They will see on a W-2 and then probably get confused and say why they report low amounts than what I actually work for. So the overtime is the difference between the regular pay rate and the amount that was added. That's the amount that is going to be considered as overtime for these purposes. I think it's clear, right? So that's the amount you can exclude. Again, there is a threshold, as explained. 150, same as tips, and $300,000 for married filing jointly. Yes? Yeah, so the question is how the employer will be able to keep track of the overtime throughout the year to be able to show the employee so the employee can claim that. The payroll company will handle that. So just like now, as you know, when you work overtime, your overtime gets calculated through the payroll and they report it that way. So on a W-2, there will be a section be added that the individual will receive that shows overtime that I just explained, which is not the regular plus the addition, will be just the addition, that item, so that the tax preparer will be able to see the total overtime amount and they report it in the tax system to be excluded from taxable. And here we're talking about income tax. They will still be subject to the FICA, which is the Social Security tax and the Medicare tax. So you understand those are additional taxes that we all pay for retirement and medical benefits that we expect to get when we retire. Those are standard deductions, did not change. The other thing that people are debating right now, depending on the states, some states will allow also be deductible automatically on them. We don't know what the state of Maine or other states, their approach will be. They might either go with the federal, or they can say, well, you have to add them back for the tax, for the state tax purposes. So that's something that we need to watch and see how the state will actually apply those deductions. Okay. So the bonus, you're asking if is there a bonus. So this doesn't address any bonus. If bonus is not an overtime, it won't be counted. It will be the same. Tax just as a regular income. Actually, there is a bonus taxes that get taxed differently than the regular income. So next, Joel. This was just showing the table for the tips and overtime, what is there, deduction type, below the line, and available to non-itemizers, yes. So this is, even if you did not itemize your deduction, you still get benefits of these tips and overtime deductions. And the range of phase outs, and these are temporary, as I explained, between 2025 and 2028. Okay, go next. Okay, so now there is another new deduction that was added in this tax bill. Didn't exist, but exists now, is the loan interest payment. The loan interest payment is another deduction that you can take if you purchase a vehicle and you finance it. You are paying a loan on it. As long as that vehicle was assembled in the U.S., assembled, meaning that parts have been purchased, have been made elsewhere, but the assembling happen in the U.S. As you know, some vehicles get assembled in Mexico, Canada, and other places, and then shipped here. But they are saying for those vehicles that have been assembled in the U.S., you can deduct the interest you're paying on the loan for those vehicles up to $10,000. And this is either you itemize or not. So it's not only for people who itemize the deduction. That's a good question, and I think it's both, but I will need to check, make sure, but I think it's both. As long as you purchase this year. The dealership will have that record. Yes. No, you purchase, yes. Yep. Yeah, use the mic so other people online can, yeah.
Tell them to come so they can be live. So my previous question, I think you answered that. We wanted to know this question, how do you know whether the car was assembled? You said the dealership should be able to give to you, right?
Mm-hmm.
I can't remember the other question. Yes, yes. So the provision of the tax, I think it's effective 2026. So are you saying that anything that gets purchased in 2025 will be subject to these changes? I thought the law will be effective after 2026.
No, so many provisions are effective this year. There are some that are effective 2026, but many went back to January. January 20, I believe, when Trump became the president. That's how they are. So they become effective from January this year going forward. There are few that will start 2026, but these ones that I mentioned, they're effective this year.
So for people who will be filing next year, because we're talking about individual income tax.
Yeah.
So for the tax 2025 in 2026,
yes.
all these provisions may be effective.
Yes.
Okay.
Not all of them, but some. These ones that I mentioned.
Including the standard deduction,
yes.
including the itemizations,
yes.
all these public charitables.
Yes.
Okay.
Can I go back to when you were talking about charity organizations and then the deductions that we were talking about? Mm-hmm. So here I just want to bring that to churches, for example. Let's say people who are giving tithe and all that. Are those donations?
Yes.
And are those also deductible? How will that work? What are the numbers? What are the ranges over there?
So the church is a public charity. Being a public charity is 60% of cash being given to the church, up to 60% of your AGI, adjusted gross income, or if I can just simplify it, saying that of your income. So as long as you don't give more than 60% of your income, your full donation will be deductible if you itemize, or if you don't itemize, it's up to $1,000 if you're single, or $2,000 if you're married. So let's say you give $5,000 to the church, and you take standard deduction, and that $2,000 is less than 60% of your income, then you can only deduct $2,000.
Okay, that's a good thing.
Yep.
Thank you.
Okay. Sure.
We just want to clarify the 60%. Mm-hmm. So you're talking about being deducted at 100% of your donation. But the deduction, people may not be confused whether if I gave 5,000, am I going to get 5,000 back, or it's only 60% of the 5,000 that I gave?
So, yeah, two things. One is either you itemize your deduction or you take standard deduction. If you itemize your deduction, you can deduct 100% of your donation up to 60% of your income.
Okay.
So, in example, you make $50,000. Your 60% is $30,000. If you give to the church $30,000 and you itemize your deduction, all of it will be tax deductible.
Right.
But if you take standard deduction, the limitation is $1,000 for single, $2,000 for married filing jointly.
So that people understand, you're not getting back the 30,000.
Yes.
You're just getting back. You can deduct up to that amount, depending on how much taxes they will deduct based on your bracket.
Yes, and that's another thing people need to understand. It's not dollar to dollar for donation in terms of, it's not a credit, it's a deduction. Credit is when, let's say, you get that money back. You are not getting the money back, you're excluding it for being taxed.
Yes.
So that's the difference we need to understand when we
Yeah, I have a question.
Sure.
I don't understand how we're going to choose itemized deduction or standard deduction.
Okay. So the standard deduction is the amount that the government gives you. No, the law, I shouldn't say the government. The law gives you, allows you to deduct without consideration of how much you spend that is allowable by the law, right? So as I gave you, I said it will be $15,750 for single, $31,500 for married filing jointly. So that's a standard deduction. Most of people will take that because they don't have their own expenses that are allowed by the law. That's past the $31,500 for married filing jointly. So, but let's say now you look at your expenses that are allowed, which I'm going to list a few of them, like taxes, state taxes that we talked about. If you have your primary residence, there is an interest that you paid, right, on your mortgage. It counts. Then you take property tax, it counts. State tax income that you paid, it counts. It goes that you keep adding those items. Now you paid mortgage premium. You paid in a year, you add that. If after adding donation, you gave donation, you add that. If you add all of that amount, of those items, and they become more than $31,500, then you take that. You move from standard, you go to the itemized deduction. So that's how you judge which deduction benefits you. It's by comparing those expenses one by one that you're paying, because not everyone pays mortgage. Not everyone make the donations. Not everyone pay property taxes. Not everyone pay interest. So if those items that I mentioned, they are total, is more than your standard deduction, then you will take that. If it's less, it's better just to take the standard deduction.
The last question is about this interest deduction for the car. Mm-hmm. So it's this permanent law or it's a temporary?
This one is temporary too. It's through 2028. Okay. So, yes, there are more questions there. Yes, there are more questions online that we need to answer to. But yes, let's first finish somewhere in person.
I wonder if we can finish and then have a session of question and answers.
Yeah, I think people may forget probably their questions. So that's why we open up. If someone as a question that come, we can ask and we answer that and we keep going.
All right, thank you.
Yeah, thank you. All right, go for it, Joel.
So there's a few questions online. One of them asks, kindly explain more on the perspective of business seeking app on C Corp, S Corp, and sole proprietorship.
So we are not there yet. So I said that question, we can hold it until the end.
Okay.
Go for the ones that we've already presented. But we'll answer that question. We're still on in the video. Okay. So let's keep going. We'll come back to those questions. So now, the other item on the video is the child tax credit. I know some of you still get the child tax credit. Some, because of their income threshold, they can no longer get child tax credit. What is child tax credit is the credit. This is more beneficial than a deduction. This is a credit. Credit means dollar to dollar to your taxes. Deduction is just the amount that you can be taxed on. But this reduces your actual tax that you owe. So it's more beneficial. As you know, before TCAJ law passed, which was in 2017, they used to have $1,000 for child tax credit per child. If you're qualified, there is a threshold of how much you can make to be qualified for child tax credit. And if you have any child that is under 17 years old, you can take this child tax credit. That age did not change with the new one. So TCAJ, when it passed temporary, which was going to expire this, by increasing that amount to $2,000. If you remember, for those who have been taking that credit, they used to have the child tax credit of $2,000 per child, which is huge. If you have 4 children, you can think about getting $8,000 as a deduction as long as they're under 17. But that was going to expire, as we're talking about temporary, was going to expire and going back to 1,000 starting next year, 2026. So now they extended it and increased it. And the good thing is they revert starting 2025. So 2025, instead of $2,000, there will be $2,200 per child who is under 17. As long as you're qualified under the income, you can deduct that as a child tax credit. And that will continue to be adjusted over time. And the income is, if you are single with a head of household, is $200,000 total income to be eligible to deduct, which they increase that. $400,000 if you're married filing jointly. Once you pass that income, it phases out. You start losing that credit. So that you know, for those who have higher income. And there is the refundable what they call additional child tax credit. So if, let's say, for example, you owe $0 to the federal, they used to take a portion of that you're eligible, they make it refundable. So let's say, for example, your tax liability was $0 and you have one child who was eligible for $2,000. Under the current law, the law that exists before this new one, you could deduct $1,400. They could refund you as a refund $1,400 out of the $2,000. Now they've increased it to $17,000. And $1,700, sorry. Yeah, $1,700 starting this year, and those will continue being adjusted for inflation. So, is that clear for the child tax credit? Okay. Now, there is another one that is not applicable for many people here, or all of us, is what they call gift tax or estate tax. This was huge for folks that have more money and they want to pass it to the next generation. Maybe it will apply to us in the future. As you know, if you give a big gift to someone, the law requires that you pay tax on it. And these taxes go even up to 40%. So let's say Gapapa just won a lottery of $40 million. And they want to give to his child $20 million. He'll be taxed for that donation. So now they're excluding, even if it was 15, before it was up to 11, I think was $11 million. That's once you donate more than $11 million, you will be taxed for that amount that is above as gift tax. Now they've increased that to 15,000 for single, and 15 million for single, and the 30 million for married, for a couple. So that's another change that happened mostly for state tax or what they call gift tax, to increase the amounts of people can donate more to the next generation without being subject to the tax. This could look like weird. Why it's my money I'm giving to someone? Why the government want to tax it? But that's the law. No. Yeah, it's only you pay tax on giving to someone. But if you give to your child will not pay tax for it. Anyone, is any donor who give it to anyone. Yeah. It's not just limit the parent to the, from parent to the child. Yes.
There's a question online here that asks, what's the threshold to qualify for child tax credit?
Okay, so it was the threshold is for a head of household is $200,000 of total income. No more than that. If you earn more than that, you start phasing out. For each $1,000 above the threshold, you lose $50. And for married filing jointly, is double, $400,000. Once you earn more than $400,000, you start losing. For each $1,000, you lose $50. So it can go quickly and it phase out.
There's another one. It says, does the 60% deduction limit for non-profit donations apply to gross income or net income?
It's applied to, and we're talking about individual income here, not business. So it applies to adjusted gross income, which is kind of gross income before deductions. Any other questions on that? Okay. We go next. We're about to finish on individual side. Few other changes that happen is the expenses on K-12, which is primary and the secondary education. You know, K-12 is from kindergarten to senior in high school. So the way that the law allows the existing law before the new one, if you can save some money in the plan called mostly 529 plans, where you can put in that, you can open that account, you put the money for your child to go to private school, for example, for primary and the secondary school, then any income earned from that account, it could be a savings account, it could be an investment account, will not be taxable as long as you pay for those qualified expenses, which usually is the funds to pay for qualified expenses, which are mostly tuition related to your child who is going to the private school. So they increase now the amount up to $10,000 that you can put in that plan. And also they expand the expenses. It used to be tuition only. Now they've expand that. It could be curriculum material, textbooks, all expenses related to that education of your child will also be qualified to use that account after it grows for tax-free. So remember, I want to make clear here, when you put that money in, you put the money in that account, it's not tax deductible. So you understand, because some people think, oh, I'm putting $10,000 in this plan, so why I'm not getting tax benefits? That is not the case. It's the money that after it goes to that account, it grows tax-free, as long as you use those funds for qualified education. Is that clear?
So the question I have there is for elementary and high school. How, because it's always hard for these schools to accept these gifts or 529 payments. It's easy for college, but it's not always easy for primary and high school. How do we use that?
So if you have an account that is in qualified 529,
Yes.
you can write a check from that account.
No, they don't. Usually, it's the next gen.
Yes.
That's a perfect example.
Yes.
The next gen, you don't have an account there. You can transfer because it's within the Bank of America. You can transfer your funds from next gen to your Bank of America account and then make a payment that way.
That's one option. Yep.
Okay.
Yep.
Okay.
Yeah, that's one option. You can transfer that, and as long as you have documentation showing that you are paying for qualified expenses, you are fine. Even though we withdraw the account, because when you withdraw the money, you get a paper that you need to file your tax return, and then during the tax return there will be a question whether you've used those withdrawals for qualified education, and you have a paper for that.
Yeah. Yes. I think that's where it gets tricky. Because on the tax return itself, the software, they don't really specify whether it's elementary or, because they assume, most of the software assume that it's paying for only higher education, which is college. So I'm not sure if they have extended the questionnaire to include, have you used this money for any elementary or high school? So that's the tricky piece.
I think it's general. They make it general. They are not specific. But again, it's up to the taxpayer to have proper documentation to justify that in case the IRS comes to you.
Okay, thank you.
So this is something that, as a parent, we need to consider as a saving for the kids. And with that, I'm going to add also Joel, you can go next.
But before you go there, for folks who are parents, there is a promotion for 529 right now. For folks who are interested in opening account 529, there is an incentive for those who can do that now. I think I have a lot of pamphlets at my office in downtown. I didn't know, I could have brought them to share. If you open an account, they can match up to a certain amount right now if you open a next gen. And again, remember, next gen, it's not only for young kids. Even for adults who want to use that, you can still also do the savings.
Yeah, that's a good point, Claude. And this is more a benefit than most people leave it on the table. I actually take advantage of that. They give me $300 per child every year because I've contributed $600. So they match 50% of what you put in every year to that account. If you're expecting your children one day they're going to go to college, or even for the K-12 now, it's better you save there and they get the matching for the state of Maine that's providing. It's huge benefits that's could help you. And for the newborn, there is even one that comes, $500 that comes, and then as they continue, they contribute more. So. Yeah, you can set up an account outside. Some employers may allow you to do that, but you can also on your own set up an account with NextGen. And then I think it's the Bank of Merrill Lynch from Bank of America. They have an account you can set up and make automatic payments that can come. It could be $50 every month if you want for a child, and then the state of Maine will match it for you. So there is an instruction online. There is a page that shows you how you can set up an account and be able to contribute.
So I want to ask a question on that. If you do pay your NextGen after tax, do they can still charge it? Because if you set up an automatic deduction from your bank account going into the NextGen account, I assume that it won't be taxable even if you withdraw the money, because it's already being taxed, unless you want to set up like a 401k pre-tax and they put the money there for pre-tax.
So you're asking if it is done by your employer?
Yes.
So they have an option of doing it pre-tax, or it has to be after tax. It can be pre-tax, it has to be after tax because it's taxable.
Okay.
So they can deduct as after tax, and they will be reported that way.
So the only downside is if you use the money not for college, then you get penalized for it.
For the portion that's was added and on those funds, because the principal, they don't tax it because it's your principal. They only tax you for the
capital
difference.
or the gain.
For the gain, and
Okay.
but the gain gets not taxable if you expense it to qualified expenses.
Thank you.
Okay, so one other thing I want to mention here that came into this tax is the so-called Trump account, or Jumpstart Retirement Savings for Kids. This is a program that is between now, in the new bill, 2025 to 2028. For those who are still expecting kids, they will benefit from this. He provides that, they haven't said how it's going to work, but it's in the bill. If you have a newborn between now and 2028, the government will contribute. It's kind of the 521 plan that we just explained. The government will contribute $1,000 toward that account, like if initial funding. Just like 529 plan with the NextGen plan, they put $500 for any child who is born in Maine. So this will be in the country. Anyone who is born in the country between now and 2028 will get an account set up and benefit $1,000 from the government. They haven't clarified how this is going to work. It could be a parent open up an account and they get that as a credit after putting a $1,000 in that account, get it as a credit, or refundable credit on a tax return, or the government can just transfer that money to that account. So there are few rules here that we need to be clear about. The child will be born, will be between now and 2028 to be benefit the 1,000. But also in addition to that, you cannot touch that account until the child turns 18. So it's an investment that you are making for that child to help pay for eligible expenses that are on the list. And it's a savings. It's not like for education, it's mostly for retirement. But the child can use it after turning 18. You can also match for other children that exist, but you're not going to get the 1,000, but the contribution that you're making will be tax deductible. If you make to an older child, the child who was born before this year will not get the 1,000, but you can contribute. They are talking about up to 5,000 contribution, $5,000 a year. That's you can. They call it not non-deductible, but it will grow also in that account tax-free, just like the 529 plan. Also, your employer can contribute towards your dependent to that account and get it as an expense. And you, if the employer does it, it won't be counted toward as an income because it goes to the account. So that's something that's it was added and is a good one to help people saving for future. And yeah, so Joel, go next. So that's another one, but it's between now and 2028. After 2028, there is not going to be any match, or the savings that we'll have will continue, but this is just contribution that is temporary unless the Congress then they renew them through a new tax bill. I also want to mention on individual few credits that expired that were beneficial for some. I actually benefit from it. Was what they call energy efficiency improvement credit. So if you did energy efficiency improvement in your home, the federal used to give you a credit as a result of that. Like you install a new pump, or you change your boiler from oil to natural gas, or you insulated your house. Those expenses you used to have a credit that will offset those expenses on an individual level. Those are gone starting 2026. Yeah, so they are starting 2026. They won't be applicable. If you have them, you need to do them now, so you can take this last one. The other one is the EV, electrical vehicles. They used to be a credit if you buy a vehicle that is assembled in the US, that is an electrical vehicle. You get a credit from federal. For new vehicle used to be $7,500. For used vehicle, $4,000. It still is until September. So until September 30th. After that, it's going to expire. You probably, if you've been watching news, there are some issues between Trump and Elon because of this credit being going away, because they will affect the pricing. I actually purchased my Tesla and get off $7,500 from the price immediately. So that's a huge benefit. That's kind of giving incentives to individuals to buy electrical vehicles. So now you have to pay the full amount. So that's something is gone. Hopefully you come back. And in addition to other for business, a lot of credits. There used to be 30% of solar credit. If you install a solar to your home, you used to get a 30% credit from federal. That's going to go away too. But they added some other on the business side, like coal credit. So those are the changes that affect individuals, key changes that are affecting individuals. I'll see if there are any other questions on individuals before we move to the business side. Then for those going to stay a little bit here in person, as I said at the beginning, I'll share with you, because I have some of folks came for other things that this bill impacts their day-to-day life, like Mama Mariam and the others, on the benefits that they currently are on. Mm-hmm.
Maybe you're going to explain this to the senior. Are seniors required on SSI to file an income tax?
No, they are not required to file income tax for receiving only Social Security benefits. But as you know, and that's something that I haven't been speaking about publicly for the state of Maine only residents. Maine does provide refunds, and many seniors are leaving that on the table. So there's a sale and rental and property tax rebate that's senior eligible regardless of their income that they can get if they file for the state. That's why they can file. Yes. Yes, for the state of Maine. But they are not required to file for SSI only as income because they don't have, it's not much. Yeah. Unless you have SSI plus additional income. So then you have to file and include the SSI too as an income. Yeah, but it won't be taxed. There's some exclusion there depending on the size of income. Joel, do you have some online questions on the individual side?
Yeah, there's one quick question on, they asked if you can speak on child care credit.
Mm-hmm.
Yeah, that was the question.
Okay, I did speak on that. Maybe I can repeat again briefly. So the child tax credit, we talked about two types of child tax credits, regular child tax credit and also refundable or additional child tax credit. The child tax credit is the credit that you receive as a credit against to reduce your taxes when you have a child that is under 17 years old. So the previous law was allowing to deduct up to $2,000 through this year, and then starting next year, it was going to revert back to $1,000 per child. This new bill introduced a new deduction, not a new deduction, but extended the existing deduction to become permanent and also increase it to $2,200. And I think it's permanent. I need to make sure I'm not saying. Yeah. So, yeah, $2,200 in 2025, and this amount will continue being adjusted for inflation each year, and that will be per child who is under 17 years old. But there is a threshold limit on the incomes for the parents. If a parent is just one parent with the children, the maximum to take the entire deduction is $200,000 in income. If it's more than $200,000, it starts phasing out $50 for each $1,000 additional in income. For married filing jointly, it starts phasing out at $400,000. And that's, we're talking about the child tax credit. If it's an additional child tax credit, is when your taxable income is zero. The remaining child tax credit can be refundable, and that was increased up to $1,700 a year per child instead of $1,400 as it used to be.
I just want to add to what Didier said. All this stuff that he shared, we're not really supposed to memorize them. But the one good thing that we may return here is when your tax preparer is educated on this credit. So I don't think we expect, or did you expect you to memorize all the maximum child tax credit, what are you going to do with the standard deduction? Most of the software will come with this stuff that they use. They will update the software based on the provision on the bill. However, if your tax preparer does not get the information that is the changes made, you may be missing out on some of these benefits. So that's the piece that you need to return. When you go do your taxes, ask your tax preparer, are you informed on the changes? Are you educated? Otherwise, they may just do business as usual, and then you're the one that are going to miss out. I don't think you have the capability of memorizing and knowing all these changes, but your tax preparer should. Thank you.
Yeah, thank you.
Yeah, Mr. Didier, there was one other question about child care credit. Yeah, they wanted you to talk about it briefly.
Yeah, so there weren't changes to the child care credit, and the child care credit is when you have a children and you send them to a daycare or another care that is qualified to be considered as dependent care. They usually have an EIN and they provide care to the children, and I think it's 12 years old or under. When you pay those expenses, could be deductible or get a credit for dependent care. So I didn't prepare for that to include in the presentation, but that's a credit that exists and will continue depending on eligibility. And each state has its own law also to allow, even at state level, to deduct or get a credit for the expenses that you paid to a qualified child care provider. So that's another credit that you can benefit if you have a child that you send to a child care.
And for that particular case, they just need to, again, return the record. The child care provider should be able to provide the EIN number and probably the location of the provider so that they can be used. Unless you are using individual who's taking care of your child, then you can use the Social Security number.
Yep. So Claude is adding, saying that there are some additional requirements and they mostly need to come from the child care provider who provide a report, a statement showing the amount that you've paid for your child and also the information including their tax identification number. Okay, any other questions?
I have a question.
Sure.
Yeah, I wanted to ask about filing jointly. If a couple files jointly, but one earns zero in that particular year, do they still qualify, like, to get the benefits of filing jointly, or because one person has earned,
Yep.
they are gonna lose the benefits of filing jointly?
Yeah, that's a good question. So for benefits based on the filing status, is not based on the income. It's based on just individuals filing together because they are married versus not married. So that means even if only one works and the other one doesn't work, still you're eligible for the benefit for married filing jointly versus not filing as married filing jointly.
That's a good question. Matter of fact, you lose benefits if you file separate while married. So because they see that one is going to file like a head of household and or single, for the sake of maybe trying to hide for taxes, people can choose to file married separate. In that case, you lose the benefits of those kids that you're using. For instance, if a single is the standard deduction is $15,000, but the married couple is $31,500. So when you choose to file a single, you won't get the benefits of the kids. That will be going away. People will always ask this question: why do I need to file a joint if they can do separate and even divide the kids? That's wrong. Because you are calling yourself a head of household with some of your kids and your wife or husband takes the other kids. You're technically married as of December 31st of that tax year. If you are still married, because you answer no, when they ask you, were you married by this time? You said no. That's already a lie. So in this age of Trump, you could be in trouble. People may choose to get more money in their pocket, but they don't know that they are committing crimes by lying under oath, and you take the government money. Am I right?
Yeah, and I don't think this group does that or anyone, but it's no one is actually should be tempted to do something that is wrong. And there is just understanding in principle, if you do things right, as Claude explained, married filing jointly provide you more benefits than married filing separately. It's still legal to file married filing separately, but you don't get benefits unless you do something wrong.
Maybe to add to that, this is different from what you claim on your W-4. You can still be single and then claim something different.
Yes. So the question is, how is this different from what you file on your W-4 forms? So your W-4 forms, usually those are like estimate, advances that you want. You can say no taxes in all the forms and they won't withhold any taxes. And then, as I said, the system here, you pay tax during tax filing. So you can claim, and I've had people asking me, like, if I'm married, why are you asking me to fill the form saying being taxed as a single? But you choose that just so that they can withhold enough tax, and then you don't have to pay when it comes to the tax filing. It's when you file that you have to be correct with your status. Okay.
One last question.
Yep.
I heard a lot on I-10 because of the Trump. Yeah, I'm sure people are familiar with the I-10. Individual tax
number.
Yes. For mostly people who don't have a Social Security number, they can use I-10 to file. Are the I-10 still going to be, people with the I-10 still going to be eligible to file?
Yes, they're still eligible to file. The only thing that I didn't mention on it under like benefits, some benefits they are not going to be eligible to take, including the child tax credit that require now both parents, if you're married, filing jointly, and the one has I-10 and the other one has social, both have to have social to be able to be eligible for the tax credit. Yeah. So there are so many things focusing on legal residents and citizens that we'll talk that later also, just on the other benefits. But on the tax side, you're right. There are some limitations now have been changed to be able to get some of the tax credits. Okay, let's move on quickly, and we'll still get some questions even after. So let's talk about the business side. There's not much on the business side that we need to present. There are very few key changes. Go next to the OBB federal implications. Next. Yep, starting there. So the main thing that's happened that is really in the business side impactful in this new bill is the provision that's allow for bonus depreciation and also what they call Section 179 deduction. So the 100 bonus depreciation, as you recall, in the Tax Cut Job Act provision introduced this bonus depreciation, but was just temporary. And it was going to expire this year, which allowed, and it was phasing out every year, which allowed that if on a business side, let's say you have a rental property. That's the kind of typical example that I can use. You have a rental property that you purchased and you're renting it. You could be allowed in the past that you take some of the expenses. Normally, you depreciate that over 27 and a half years if it's a residential, or more if it's a commercial property, meaning that's like office building, because they tend to last more. So the IRS give them more years than residential properties. So if it's a residential property, normally you have what they call depreciation. You divide the cost over 27 and a half years, and you take that portion every year as an additional deduction for the business. So when the TCJA passed in 2017, they allowed that in the first year you could take what they call bonus depreciation, 100%, then the following year 80%, and it will phase out this year, will be the last year. And meaning if they have purchased that house, instead of dividing it by 27 and a half, I have an option of breaking the house in pieces through what they call cost segregation. So you have a study done. There are people qualified for that, or you can do it yourself if you feel qualified. There's no credential required. As long as you have proper documentation to give the IRS. You know the house is made by many components. There's a flooring, there's appliances, there is a windows, there is a roofing, there is a drywalls. So in those components, some of them, they have a life expectancy of over 15 years. Some have less than 15 years. So the TCJA allow that those components that are 15 years and less, you can take bonus depreciation and write them off in the first year, which is huge. So if, let's say, windows, doors, floorings, appliances, they have life expectancy that less than 15 years, all the costs associated with those components will be an expense in 1 year. And I've done those studies. Most of the time I found that between 30 to 50% of the cost of the house can be written off. So that's a huge deduction that you get as a business. So that was going to phase out. That's for the house. So there is also what they call 179 deduction, Section 179 deduction, which allows like equipment, vehicles, business vehicles. Those are like 5 years. They are all under 15 years, obviously, all of them. That they could be depreciated over those lifetime expectancy of those equipment or vehicles. Now they allow also them, you can also take bonus depreciation. So you can buy a business vehicle today and write off all as an expense to your business on the tax return. And this has become permanent. So it's not expiring unless the Congress come and change it, but it's going to stay as a permanent. Same thing with the bonus depreciation. If you purchase a business property and you want to depreciate, you do the cost segregation, you can write off everything that is less than 15 years. So this is what people are talking about, the business strategy that people need to start thinking. If you know you're going to owe tax this year, this is the right time to start planning and thinking how you're going to reduce the tax by taking advantage of these provisions. Yes. Microphone. Who has microphone?
Thank you. Would the bonus depreciation for real estates be applied to properties that were acquired previously or just from this year onwards?
Is the property we purchased this year going forward?
Oh, okay.
Yep.
Thank you.
Yeah. Going forward, not going back in 2024. Yeah.
Just one.
You have a question? Okay. Yes. So the question was like, if it is applied for last year, so we say it's only this year going forward, but at least it goes back to January, as I explained. So another business deduction is the so-called qualified business income deduction. Qualified business, QBI, mostly in abbreviation. So this deduction, for those who receive K1, will remember this. So if you're an S corporation, you have an S corporation and you are a member of that LLC, and you file, the business file a tax return, that business is not taxable because it's not a C corporation, will flow its income through the K1 to members. And then let's say you are a member, you receive a K1. When you receive that K1, there is a under TCJA a deduction that was given, and this was a debate to compensate people who have S corp and a partnership versus people who have C corporation, because when they lowered the tax rate of C corporation in 2017, people who have S corporation, and they were complaining. There were debates in the Congress like, well, you are giving a big tax cut to the C corporation. What about other type of businesses? So they allowed this QBI deduction to be there. But that was temporary, but now it's being made permanent. They were given temporary to deduct 20% of their K1 income before that income gets added to your regular income and get taxed. So that now has become permanent. That if you get a K1, your income through the K1 will get a benefit of that deduction of 20%. Then it will be taxed only on 80%. But that's going to the next slide, Joel. That's just remember the other one, next one. Yes. It goes down, phase out, depending on the income and depending on the type of that business is. So they divide them into two categories. One is called specified service trades or businesses. Specified service businesses, meaning like lawyer, accountants, that's a specified service business, right? So if you are under that category and you receive the K1 and as an income, once you get to $200,000, past $200,000 on a K1, you no longer get the entire 20% deduction. It starts phasing out. And it's phasing out, and it can go up to zero. If you're single or if you're married, depending on the income, there's a different threshold. Go to next slide. If you are not specified service trades or businesses, then the threshold is a little bit higher, and they get limit to 10%. So some people have seen when I do taxes, and I see K1 for some of the people giving to me, they don't get that 20%. And they question why I should get the QBI is because of the amount on the K1 is higher than the threshold, is now phasing out. If it's from an accounting firm, it goes to zero. If it's for non-specified service, it stops to 10%, so it gets reduced. So that's another thing that you need to consider when you have a business and your income is changing on a K1. I usually talk to people sometimes like maybe consider become a C Corp. It can benefit you because there's no those limitations that we're seeing here. Type of. But that's the difference. And the major thing under this new law is that they make it permanent. And the other thing is that they allow that even a small, let's say you have a rental property. Even if you have a rental property, that's another business. You also qualify to get a QBI deduction on the income that you make on that rental property as a business. Or if you're an Uber driver and you run that as a business, you could also have a deduction, QBI deduction. And they're saying that the minimum deduction you can get is $400. So it doesn't go to zero, it can go to $400. But again, as I explained before, there are some limitations based on the amount of income reported on a K1. Those are main changes on individual and business taxes. So now I'll just, before I go, we finish with the people online. If there's another question, we'll address that. And I'm going to go back to the question on that you asked about the C corporation and the partnership. But before we go to that question, I want to ask if there is any questions in the audience. Then we go to the online. Okay. So we start with that one, Joel?
Yeah, we can start with that one. So it says, kindly explain more on perspective of business seeking up on S Corp, C Corp, and sole proprietorship.
Okay. So most of the time when someone starts a business, the most common type of business people go to is LLCs. LLCs stand for limited liability companies. Why limited liability companies? Is because it gives more protections than other type of proprietorship or partnership in terms of a legal side. Just like there is a firewall between LLC and the owner legally. If the LLC gets sued, they will not, if the LLC cannot pay for damage, they will not go to the owner to be able to pay the gap or to fill the gap or pay the remaining amount. Same thing protect also the individual. If the individual is sued or is in a litigation, the court will not require the LLC to be part of that litigation. So that's why many people choose to go with LLC. And that's a legal entity. So there's a LLC, LLP, there's a partnership, general partnership, limited partnership. So there are so many type of sole proprietorships that exist that are legal entities. And then there is a C corporation. C corporation is just kind of completely legal entity that's it's on its own. Does not have any person who will be considered as attached to that C corporation. You can be a majority shareholder or you can be the only sole shareholder. But for the legal purposes, the C corporation is just an entity that stands alone. When it comes to tax, so if you're LLC, you still have to choose the way you're going to be treated for tax purposes. And that's what sometimes people get confused, like, well, how do you get taxed? Oh, I'm taxed as an LLC. There is no such a thing for taxes. They don't tax you as an LLC. There is a type of structure that the IRS code provides for different type of entities. So if your entity is an LLC, you can elect by default. If you don't elect, you just file for EIN. By default, if you have more than one ownership, meaning more than one owner, you become a partnership. If you are only one owner for that LLC and you file for EIN without electing, you become a sole proprietorship. The sole proprietorship meaning that your entity is disregarded entity for tax purposes. That means you don't exist except for legal reasons. For tax reasons, you are the same as yourself, and you file the tax return, individual tax return, and you add your LLC. sole proprietorship to that return.
Even though you have your EIN number
Yes.
active.
Yes.
Okay.
So Didier, go back to the LLC. I know the C corp, the company or the C corporation file its own taxes, independent on you. But the LLC, which is a partnership, so then don't you get the income from the LLC, which is added to your own taxes?
I will get there, Claude. Let's finish the structure first.
Okay.
Yeah. So now as a sole proprietorship, for tax purposes, you don't exist. Of course, you can put the name and the EIN on that, but that it's on your own individual tax return. It will be a business, but on what they call Schedule C, that's where we put our Schedule E if it's a rental income. When you're a partnership, if you have two members, as I said, if you didn't elect and you have two members of LLC, you become a partnership by default. When you become a partnership, you have to file so-called informational tax return. The informational tax return is to inform the IRS the entity doesn't pay tax. The tax return he files is to inform the IRS, me and X, we partner to do this business, and this is our income, and we divide it based on the percentage, and we generate that on that form called K1. We're going to report it on our own tax return. So that's the partnership. Partnership is not taxable entity. It's just informational entity for tax purposes. You file, and then they generate K1. K1 goes to the individuals, and individuals, they file their own tax return, combine the K1 and the other income. So then, let's say now you say, well, I don't want to be a partnership, or I don't want to be a sole proprietorship. You can elect to be an S Corp, which is a small corporation, or you can elect to be a C Corp, which is a regular corporation. So to be an S Corp, the difference between S Corp and the C Corp, S Corp, you keep the same status of partnership. You're still not taxable. The advantage only of being an S Corp, which is more popular also entity, it allows the owners to be employees of the entity. If you're a partnership, you cannot be an employee of a partnership as an owner. If you get paid by partnership, they call it guaranteed payment. It's not a W-2. To be on a W-2 for your entity as a partnership, you need to change your status and become an S corporation. So that's another reason why people change from being a partnership, become an S corporation. But the flow of income stays the same. Your income will not be taxed at an S Corp. S Corp will file informational tax return, generate K1 like a partnership, and then a K1 will go to individuals, and then individuals will include that into their income. It's clear, right? So when you become a C Corp, that becomes totally different. C Corp get taxed. So a C Corp is a taxable entity, will file his own tax return and will pay his own tax, and his income will not be reported on your individual tax return. So if I own a C corporation, I'm the only shareholder of my C corporation. My tax return as an individual will only show my own income without including income generated through the C corporation. And the C corporation will only file his own tax return with his own income. And it will be on the bracket, tax bracket, which is currently flat 21% tax on C corporation. It's clear, right?
I guess to clarify, if you have a C corp, even if you are a sole entity, you file as a C corp separate. You pay taxes separate than your regular income that you file through 1040. But if you are LLC, the K1 get generated, added it to your 1040, and you file together with your individual income tax.
If you're a partnership or
Right.
not LLC, because C Corp can be an LLC.
Okay,
Yeah.
if you're a partnership or sole proprietorship.
Yes. Or S Corporation. Yeah. Joel, any other questions there?
Yes, there's another question. The question says, can you clarify if a taxpayer has both W-2 income and sole proprietorship related income and also receives dividends from another company, what are the thresholds?
Yeah, I won't be able to tell the threshold because the threshold will depend on how much and also depend on the situation of a person, if single, non-single, but all of those sources of income will be reported on 1040, which is individual tax return, and combined, of course, income that flows from S Corp or partnership will receive 20% deduction, QBI, qualified business income deduction, and then after that will be combined with W-2 income, and if there are other personal business income that's sole proprietorship will also be combined. And then if you fall under the thresholds of what we say, of married or single, you get your standard deduction if you're using standard deduction, and then after that you can be taxable based on the brackets.
So the next question says, did the tax brackets change too? If yes, and they were talking about this is the individual side. So the question says, did the tax brackets change? If yes, give a little bit of explanation with each group and how they were affected.
Yeah, the tax bracket did not change. They're going to stay the same. They were going to expire. The existing tax bracket, they were going to expire this year. But they now been extended, and the only thing that's going to change starting 2026 is the adjustment based on the inflation of the amount that falls into each category. But the bracket is still 10, 12, up to 37%.
Great. The next question asks, kindly advise what it means if you have to do a tax extension beyond April or June periods. Are there any charges?
Okay. So that's a good question. People confuse extension and a payment. So if there is no extension for payment, you can extend payment of tax return. Beyond, that's the extension period. You can extend filing. By April 15, you can file an extension and extend your tax return until October 15 as an individual. So when you extend it, if you owe taxes, you better pay them as estimated taxes to avoid penalties for late payment. If you don't, you're going to face late payment penalties. But if, let's say, you don't owe, and I had one question that someone explained it in the wrong way to a lender, and they told him that I told him, and the lender said that you need to find another CPA because your CPA gave you the wrong answer. So is that someone asked me and said, well, I didn't extend my tax return. And I asked him, okay, are you going to owe any tax? He said, no, I'm going to get a refund. I said, well, you're fined 3 years. If you don't file, it's up to you. You have until 3 years because it's the IRS that owes you, and they don't put any limit for someone they owe money. So he went to apply for the loan, and the mortgagor said, did you file an extension? He said, no, my CPA told me I don't need to. And he told him, so for him, he didn't know his status, whether he's going to owe tax return or he's going to be getting refund, and they get that answer. So he told me back, and then I said, what did you tell him? So I brought it up to explain to you that if you don't owe any taxes, you can file up to 3 years your tax return and get your refund. After that, the law said you might not get your refund. But if you know you're going to owe and you did not file an extension, then you're going to face both penalty for not filing extension and for not paying tax on time. Yes, go ahead. You have a microphone?
So is that particular explanation does it apply to all types of taxpayers, including businesses?
Yes, but the time is different.
Okay, because my particular...
And also, just to be, there are some differences.
Okay.
Yeah.
So if I don't, if I apply for an extension, but in most cases I'm not fully aware whether I owe taxes or not, in most cases, because my tax filer sometimes is the one who does the extension for filing, and I didn't know that I will owe tax until October 15th, and then that means I will be liable for penalties for not paying taxes on time?
Yes.
Okay.
Yep. So you need to make what they call estimated taxes.
Okay.
So for the business side, what the law provides is that you'll be paying penalty if you underpay your taxes by due date, compare either to last year's return, if you pay less than what you paid last year return, or this year, whichever is lower. So, and also just one thing to clarify, the deadlines are different. So there is the partnership and S corporation, their deadline is March 15. By the March 15, you have to file an extension. For individuals and C corporation is April 15.
I had one
Yes.
other point to say. It's not a question. It's regarding the legality. You mentioned it, the protection between the individual and the LLC. I just want to caution people concerning personal guarantee. Sometimes when you are engaging into a contract and the other party requires you to provide a personal guarantee for your LLC, you are still liable for anything, even if there was a protection that would save you if the LLC was being sued or anything like that. Thank you.
Yes, you're right. The guarantee is a guarantee. When you provide a guarantee to individuals, you are liable to it. Same thing with co-signing for someone's debt. You become part of the borrower. You are also part of that borrower when you sign.
I can talk more on that, how I became liable.
Yeah. So, Joel, do you have more questions there?
No.
Yeah, there's another question that asks, how will Cash App transactions be taxed?
Cash transaction? Cash App?
Yeah, Cash App transactions.
For business? So let's say, okay, cash transaction, I'll assume is for business. Because when you receive cash for peer-to-peer regularly, it's not taxable because that's the money transfer between the two. But if you engage in a business and you use Cash App as a method of payment, you should be able to receive what they call Schedule K, K19 or K something, Schedule K with another number, to state, which is a statement showing how much you received, and you have to report that income, just like 1099s that people receive when they receive an income. So yes, it's taxable. You have to include as an income for your business, and also offset that with some expenses or any expense that you have. You remind me one thing that changed in this bill too that I should mention: remittance tax. You know, people send money abroad as a cash. So this bill introduced a new tax on that money transfer. If you transfer through money order or MoneyGram or Western Union, sending to relatives like we do, if it's not coming directly through your debit card showing come from your account, you'll be subject to 1% tax. And how they're going to track that? They put the burden to the remittance agencies to keep track. They are the one who collects the tax up front and send that to the IRS. So that's, you know, that's if you're sending money abroad and they're using cash, MoneyGram or Western Union, it's better to use debit card. They say debit card, you're exempt. So if you use bank account to transfer, that's exempt. But if you're using other channels, the agency will start probably taxing you. They collect the tax on behalf of the government.
They will be able to send you 1099 the same way the other provider will do, right?
No, they will just charge you like they charge you sales tax for the state.
Oh, then they can pay the government.
Yes.
I see.
Yep.
I know.
So, random question.
Yes.
So, do you think that I heard that the bill is somehow beneficial in some ways? How do you, as a CPA, how do you rate it? I know we talked much about the taxes side. Does it benefit us, or it does benefit the rich, as they say?
The rich people like DJ.
Or even tariffs? How are they going? Because people are losing benefits. How do you say for the regular people, you know, here in the community? Yeah.
Yeah, on the tax side, it has a many positive in it that's going to help people, but also depending on how people are going to take advantage of those benefits. And there are also other sides that I want to touch them on, but just in person, because I don't want to be misinterpreted when I put online. But those we can share more. There is some other implications that this bill has on individuals, especially on immigrants.
Yeah, thank you, DJ. I think the one big, beautiful bill, whatever it is, many individuals won't be able to see the benefits right away or in a paycheck because some of the provision are the extension of the 2017 taxes which was already there. The small changes, as you heard, like maybe $200 here and there, it won't be significant. Maybe like the tip taxes or overtime taxes, but the other provision were already in existence.
Child tax credit too.
Right. So it's not going to be significant. However, for the wealthy people, they might be able to see it as an addition more than just regular people. If you look at the 200 child tax credit, or if you look at the overtime on, so you divide by how many days in a year, you probably won't even see that on your paycheck if it's less than $50 or a little bit of money. But for the wealthy, as they do taxes, probably they would see that. But the other thing that I want to say, there is a political calculations here. Some of these things will be effective in 2026, assuming that the midterm election is over. He doesn't want to upset people to see not much changes on the beautiful bill that he's chanting until after the election of midterm. That's how they're going to be effective based on that.
So yeah, Claude, don't go to the politics. We are here on just taxes. Because it could be a big debate that will take us longer. You don't have? Okay. Is Charles all set?
There's one question online, actually. They asked, can you advise on how people who still have family members in Africa can declare them? I think they were using TIN instead of using Social Security number. I think they were talking about the transfers of sending money back home. And
yeah, as long as they have Social Security. Sending money to relatives, there's nothing wrong that this bill stop people from doing. So they can still send money to their relatives. It's just going to be taxed if they send it in some way versus the other. Also, for those who have children who are U.S. citizens and they file their tax return, they can still claim those children because they are their children, regardless where they live now.
so hold on, Mr. Claude.
I-10, no,
Hold on.
on this.
Okay.
So on this issue, I don't believe that you can claim your child overseas, but you can add your spouse on I-10. I don't think the children who were born overseas can be added on your tax return if they still they don't have a Social Security or they're U.S. citizen.
No, I say U.S. citizen.
Oh, okay.
Yeah.
But your kids who are overseas, you can still add, if it's still applicable, your wife into I-10, right?
Yes, you can.
Okay,
Yeah,
thank
you
you.
can still apply for that.
Okay.
Yeah, so the question here asked, how would you declare those, I guess, funds using a TIN instead of a Social Security number?
So you can claim funds that you're sending abroad. That's not an expense for business, for tax purposes. So they need to know that that is not an eligible expense. If I'm sending money abroad, it does not mean that's an expense for tax purposes. Yeah. Yeah. Still, even if you send money, let's say you have a business in Africa and you send $100,000, that's not an expense. Even if it's like here, if you have a business and you put $100,000 on that business, you cannot claim that as an expense. That's your money. You're just moving from one pocket to the another pocket. It becomes an expense when you spend it. When that business spends it, it becomes an expense for that business. But for you, putting is like a capital contribution. Yeah. Yes, Pastor has a question. There is a mic here next.
Yeah, the question. Thank you, Didier. I've been following. I was in my office. I really following what you're doing. Assume that we have people from Africa, probably other places too. Assume that someone wants to build a house overseas. How do you make it? It becomes your under your business. If you have a business here, but you want to expand over the other side, and say, I want to build a house in Rwanda, or Burundi, or Congo, whatever. Can that be added to your property, and then it becomes what? How do we claim that?
Yeah, that's a broader question, Pastor, and it could be a little bit complicated to answer it, but the only thing that I'll say, it's a little bit complex to structure that, because when you register a business, it's registered in the state. It's not registered internationally. So your business is not even a national, it's a state business. He has to follow the rules of the state where he was incorporated. So if you want to expand to another country from where it's registered, you probably need to create another entity. but it won't be associated with the business here because the rules for the state are applied. If it's Delaware, it's just the business in Delaware. But it can also, if you do it in Maine, then you have to register with the state of Maine to follow the rules of state of Maine. You create another entity there and they register that entity. You can still have ownership. You can have ownership of other entities. Just an example of those multi-international companies like Google. Google is registered in California, and I think it's a Delaware entity, but operates in California, registered there too. But also has some affiliates, entities across the world. So those are other entities, but they are affiliates to Google. Yeah, yes, but legally they are different, and they are under different jurisdictions. So they are not in U.S. jurisdictions. They are in probably in Europe if they are in Ireland. And this has been an issue going on about how people move income.
Yes.
From U.S. not be taxed in U.S. Like Google, if you hear, oh, Google pays zero tax this year in $1 billion income. Why? Is because they have a contract with another affiliate of Google in Ireland. Ireland has a business tax return of 5%. They contract for intellectual property. All the income that Google generates in a year, it pays intellectual property to another affiliate company in Ireland. It becomes an expense for Google. Google pays zero tax. The other entity in Ireland pays 5% tax and the income stays there. The issue remains how they're going to move that money from Ireland to U.S.
Right. That's what I was going to explain, Didier.
Yes.
Because I was helping a family who sold his home overseas. I think I may have asked you this question. And trying to bring the money here to purchase another house here. So as long as the country where he's selling the property can be able to show him the documentation that this was his residential area, he could sell the house there, bring the money here, so that without getting necessarily taxes on our money. However, to the question he's asking, I believe that he doesn't have to worry about owning an asset overseas because it doesn't have nothing to do with his assets here. But until he wants to move the money to the U.S., that's when he will be subject to either taxation or where is that money going to do. That's how they check the money laundering. Why is the money coming? What was the money doing? And can you pay taxes if this was a business? I assume that's the case.
Yeah, so but there are two things there. One is business, one is personal. So on a personal level, it's different thing than business. Business, if you have a business registered in Europe, that's his own business there. It's only me, my share, my asset in that business that I'm required to report to the IRS. So on the income, you pay tax on the income. You don't pay tax on just having some on asset. So, but I want to clarify something there. That we're required by the Treasury, it's a law, Treasury Department, to report our assets. If you are a permanent resident or a U.S. citizen, you are required to report to the IRS, through the Department of Treasury, all your assets worldwide. If you don't, and you sell your property there, and you're going to bring money, you will be subject to taxable 100%. Yes. Go ahead. Repeat.
If let's say Pastor chooses to buy a house in Singapore, will they be allowed to depreciate that house under the bonus depreciation benefits we discussed previously.
As a
Here.
business?
Either way.
Because you can depreciate a property if it's your single family home. That's not for business purposes.
Okay, as a business,
Yes. As a business, yes, because the U.S. tax law is worldwide tax, income tax requirement filing.
Okay.
So you are supposed to report all your income, regardless of where it's coming from. Therefore, you can also deduct all your expenses, regardless of where they were generated.
I think that's when he's going to file 1120. Something that
1120 is a C corp tax return.
I think they went too far. Yeah, I think I agree with what he was saying. So we have two issues here.
Yes.
We have a personal house. Some people who really go and build a personal house overseas, but they don't live there. They live here. And then there's also wanting to do a business, like he said, in Singapore, for example. And in Singapore, that business property is under another entity. That's why I want to come back to the issue of Google. There's only one CEO for all Googles. Even if he's not legally the CEO of those affiliates, but there's a legal entity that shows that they are part of Google. Because mostly Google on top gives a kind of flow of the guidelines on how they can do businesses. So Google will never claim part of their shares in those areas when they want to bring their money here. Do they have to pay taxes?
So your question has many pieces, and we can go deep in that. So Google Inc.
is one. Yeah.
And that's one CEO. Can have they can be what they call subsidiaries.
Yeah.
Have another entity, either like a Google Europe.
Yeah.
I'm just naming it Google Europe, but mostly they don't name them Google. It will be something else.
Yeah.
And they say, well, we own 100% or we own 99.9% of our shares in that, but it's an independent company, a foreign entity company, not required to file anything with the U.S. Is subject to the jurisdiction of that country in Europe. So the management is independent. They have their own board. They can have influence from Google. Google can be part of the board. But eventually they'll file their own taxes as a business. But if, let's say, they are C Corp, they file their own tax there, they don't pay any dividend to Google Inc., there's nothing Google need to claim.
That's right.
But if they pay dividend to Google Inc. will pay tax on dividends that they received because Google is taxed on income generated worldwide.
So how about if they are only shares?
Yeah, if they don't take money, that's why I'm saying that they get stuck on money. They can move the money back here, and money gets stuck there. You remember when Trump passed the first 2017 Tax Cut Job Act? He gave even that bill. They gave the bill, not Trump, but everyone in the Congress passed the law, saying that everyone now is exempt up to $250 million to bring that money to U.S. It's kind of, we allow you to move the money here. We will not tax it. We're exempting you, but bring the money to U.S. Was a way of bringing the money back home because they know many people are stuck and they keep the money abroad because of fear of bringing them here and be subject to the tax.
So then about the houses, I'm talking about people who I don't own a personal house, but for people, in many places, they really build homes back home. But they are, even if they don't claim it as a kind of business, but they rent them over the other side. But they don't live there. They are not resident of those countries. They are resident of here. How does that, is it considered? Is it a kind of extra income or what?
So one thing is, if you build a house outside the U.S. and you are a permanent resident or legal resident in the U.S., I will advise you to file the form that required by the IRS. That's claim or report your assets worldwide. You show the value that you purchased those and the date and where they're located, and have that recorded. That will simplify if it was you sell that property just like a single family home here, and you did not live in it 2 years like required in the last 2 years, in the last 5 years, you pay a capital gain income, tax. Because you've reported to the IRS how much you bought it, and you sell it for more, you pay capital gain income tax. If you sell it, you're going to sell it for less, you don't pay anything. It will be just like a house that you own here. And if it's for the business, my advice to you is saying that just consider that house as if it's in the U.S. Treat it as if it's in the U.S.
You'll be able to pay taxes here and pay the other side too.
So they allow for foreign tax credit. So when you claim the taxes, you also show the tax you paid in the other country. They'll give you a credit.
But then
because it's similar. People have houses in Canada as a rental properties. They file it and they pay tax in Canada. They also pay tax here, and they offset taxes paid in Canada. And they see the difference. If tax in Canada is less than the U.S., you pay the difference. If it's more than the U.S., probably you're not going to be paying any taxes on that property in the U.S. But the issue is that if you don't claim your properties, when you sell those properties, they will tax you on 100% as if they have zero basis. Or you'll be stuck of not, you can't move the money. Yeah. So, that's okay, yeah. No, you don't pay tax. You pay tax on the income. Yeah, but if you sell it and then you earn more money, you pay taxes. Yeah. Yes. So I don't know if there's anything online. So I think we're done with online. You can turn off the camera and the recording, so we can talk about other few things before we finish. But I think it was good conversation so far. And